They're called fat finger errors, and we've all been... Wait, sorry, one second.
Alright, that's cool.
Yeah. Can you ask someone to cover my shift? Alright, sorry. Wait. What did I... No, it's calm.
Yeah.
Alright. Sorry. They're called fat finger errors, and we've all been... Wait, what the They're called fat finger errors, and we've all been there. I'm sure we can all remember that one text we sent where we accidentally said instead of duck, or how I just asked my boss to cover my instead of my shift. Now, for ordinary people like you and me, it's really not a big deal at all, because you can just fire off a quick oops my bad, and maybe they laugh at you at work, who knows, but life definitely moves on. But imagine if I wasn't texting my boss on my job as a dishwasher. But imagine if I was on Wall Street, where my salary was just a little bit higher, the suits were a little bit sharper, and the stakes were a lot higher. Today we're talking about moments where people in the world of finance hit the wrong key, and instead of a simple fix and maybe a couple people laughing at them, a single typing mistake can literally cost billions of dollars. Now, believe it or not, with all the manual typing going on in Wall Street, the world of finance is really not new to this issue at all. In fact, there's a whole section dedicated to some major examples of it in the Fat Finger Errors Wikipedia page. See, on Wall Street, precision is absolutely everything. After all, these people literally handle hundreds of millions, sometimes even billions of dollars daily, stock trades, wire transfers, you name it. And one misplaced keystroke can be the difference between buying $1 billion of a stock instead of $1 million. And it's not even just about the direct money lost either. The fallout can oftentimes be brutal. Stock prices can tank, investors can panic, and on top of that, unlike texting your boss to cover up your shit, it's often far from a quick recovery. A big enough error like this can lead to lawsuits, layouts, it can even push a firm to the brink. So hang tight, because today, we'll be taking a look at just 3 examples of some of the most disastrous multi-million-dollar oopsies in the world of finance. Tales of fat fingers and even fatter consequences. So let's jump right in. Before we jump in today, I'd like to thank today's See, I almost lied there. This video isn't sponsored. See, this is still a really small channel, and at this size, it's not really possible to attract any sponsors at all. Now, for a small channel like this, it can get really difficult to get the ball rolling. Now, the best way you could support the channel would be by checking out our Patreon linked in the description below, where you'll get exclusive early access to our videos, as well as a whole host of other benefits. Now, let's dive into our first and probably most infamous fat finger error in financial history. A small slip that led to hundreds of millions of dollars worth of damages. Let's step back to 2001, when UBS Warburg, the investment arm of the Swiss banking giant UBS, was preparing for the IPO of Dentsu, a Japanese advertising conglomerate. Now, the incident occurred in 2001, when a trader at UBS was preparing to execute the routine trade of selling 16 Dentsu shares for 610,000 yen each, or about $4,700 a share. Simple enough, right? But when the markets opened at 9 AM that day, the traders somehow entered an order to sell 610,000 shares at 16 yen each, or about 13 cents, which is barely a trade. That's more like handing a business out for some candy. At this time, Dentsu only had 135,000 shares, so the order was to sell nearly 5 times the company's entire stock at a price that wouldn't even cover the income, the paperwork. Before anyone could even blink, 65,000 of those shares had been bought up by traders who happened to win the jackpot, and UBS tried to hit the brakes, but it was too late. Dentsu's stock took a dip to around 405,000 yen before bouncing back to 470,000, and UBS had to scramble. They were borrowing shares to cover the ones that they had oversold, and they then spent days buying back the stock at the real price. Overall, the cost? Estimates put this entire disaster costing UBS anywhere between 4.5 billion yen or $37 million to as high as $71 million depending on who you ask, as UBS never gave any official numbers. But it's fair to say it really hurt their pockets. The ripple effects of this were no picnic either. The Japanese Nikkei index took a dive as people started side-eyeing the index's stability, as nothing shakes up the market like a bank accidentally dumping its own IPO. Regulators poked around, and UBS's reputation got dented as a result. Meanwhile, traders who managed to snag Dentsu shares almost for free made out like bandits, flipping the shares for an easy profit, all while UBS had to foot the bill. You'd think a big player like UBS running the show would have had such a simple IPO lockdown, but nope. One simple typo proved that even the pros can stumble. The whole situation exposed how such small mistakes can cause absolute devastation. And it's a textbook case of why double checking matters, especially when billions are on the line. But it's far from the last. It's not even the last example from the Japanese stock markets. This next story is another example of one of the worst errors in financial history. It's a story that also involves a Japanese IPO as well as the number 610,000. So here's what happened. Less than 5 years after the Dentsu story, in December 2005, the Japanese firm Mizuho Securities, which was the brokerage arm of Japan's second largest bank at the time, was handling the stock market debut of J-Com, a small Osaka-based recruitment firm on the Tokyo Stock Exchange. Now, during this long and sophisticated process, one trader intended to sell one share at 610,000 yen, or about $5,100 at the time. But instead of placing this order, due to a typo, he ended up selling 610,000 shares at 1 yen each, which is less than a penny. What makes it worse is at this time as well, the order was to sell 41 times more shares than were even in existence. The order went live at 9:41 AM, and when it did, chaos erupted. The mistake was spotted within 90 seconds, and Mizuho tried to cancel the trade 3 times, but it was just too late. By the time trading closed, Mizuho was forced to buy back the shares at a much higher than market price, and J-Com stock, which debuted at 672,000 yen, dropped to 572,000 yen, before rebounding back to 772,000 yen, fueled by a frenzy of buyers scooping up the misplaced shares. Mizuho's losses were staggering, at least 27 billion yen, or about $225 million, though some estimates later pegged it to 340 million after buybacks. The fallout didn't only affect J-Com though. The Japanese Nikkei index took about a 2% fall that day, which represented, get this, 6.4 trillion yen being wiped from the markets, which is $54.2 billion. Now after this, Japan's Financial Services Agency launched an investigation into the matter, slamming Mizuho for inadequate training and oversight. And not just Mizuho, but even the exchange itself faced some heat. Its president, Tako Tsurushima, resigned just 2 weeks later, accepting the blame for a system which would fail to halt such an obvious error. Mizuho's president, Makoto Fukuda, publicly apologized, calling it a huge problem caused by someone unintentionally ignoring alerts. But perhaps it wasn't all doom and gloom, because for every loser, there's always a winner on the other side of the trade. Some of the winners here were day traders and firms like Morgan Stanley, who ended up with a 31.2% stake in J-Com, and some cashed out big time, such as the case of 2 local traders working alone who made a nice payday of 2.6 billion yen, or $12.5 million from doing, well, absolutely nothing. Now, funnily enough, after this giant mess, Mizuho ended up suing the Tokyo Stock Exchange in 2006. They were seeking 41.5 billion yen in damages, which I think we can all agree is pretty weird, seeing as it was entirely Mizuho's fault. But nevertheless, in 2009, a court awarded them 10.7 billion yen plus some interest, totaling to 13.7 billion yen. They ruled that the exchange's faulty cancellation system bore some responsibility, and appeals dragged on to 2015 when the Supreme Court ended up upholding the decision. This whole incident forced Japan's financial sector to rethink its safeguards, especially seeing as how such a similar mistake was made less than 5 years ago. Now let's fast forward almost exactly 10 years later to December 2015 in Frankfurt, Germany, where a trader known as Armin S. stumbled upon what would be the score of a lifetime. Now Armin was a former Citigroup and West LB trader, and he'd ended up going solo, and he was at his desk looking for trades one morning when he spotted something wild. BNP Paribas, one of the biggest banks around, was offering to sell derivatives for dirt cheap. The price? 108 euros per unit. He quickly snagged 3,000 of them, shelling out 325,000 euros in total. Solid deal, right? Well, it was for Armin. But turns out, BNP had messed up big time, The real value of those securities was around 54,000 euros each, and they had accidentally put it on the market for less than 500 times its real worth. Armin's purchase was really worth 163 million euros, or $188 million at the time, way more than 326,000 that he bought it for. He just managed to turn his pocket change into a fortune. By Monday, when he checked his trading account, all the derivatives were there, all $163 million worth. Now, I'm assuming Armin would have probably been popping champagne at this point, but unfortunately, his celebrations didn't end up lasting that long. Now, BNP didn't even notice their blunder for over a week. That's over 7 days of not noticing that they'd just given away $200 million. And at one point, they'd even confirmed the trade price with Armin. Now, under normal rules, banks can cancel their mistakes as late as 11 AM at the next trading day. But BNP decided to cancel their trade at December 15th. That's way too late to do so. Armin reckoned, seeing as he literally had the price of the deal reconfirmed to him, and the bank waited for 7 working days to cancel the trade, they'd have to be forced to honor their original agreement. So Armin lawyered up, and he sued BNP in 2017, asking for 1 million euros, thinking that if the courts could agree with him on this, then BNP would have to pay the remainder, even threatening BNP with a 152 million euro suit if they decided to drag the case on. One of the biggest lawsuits by a single individual in German history. Pretty bold for a guy who, by his own admission, didn't even own a car at the time. This case really meant everything for Armin, because German lawyer fees scale with the size of the claim, so losing could have bankrupted him with his lawyer bills. And by December 2018, facing a 3-year statute of limitations, he increased his claim in the German courts to 6 million euros. But he wasn't just done there. He filed a second suit in Paris for 152 million euros, betting that the French courts might see things his way. But BNP pushed back hard, claiming that the trade was an obvious error and shouldn't stand. And in February 2019, his case was tossed from the German courts, with the courts claiming that he should have filed suit in France from the start, since his trading platform wasn't covered by German jurisdiction rules. Ouch. His French case ended up dragging on, but unfortunately, the details on this case seem to get murky from here, and it seems Armin is really unlikely to come close to getting back his almost $200 million. What's most nuts though, is how BNP missed this mistake. Internal docs later shows that they didn't book structured product orders for a whole week from December 2nd, 2015 to December 9th, meaning that they didn't account for almost 8,500 trades, one of them being Armin's trade. And Armin was probably right to call them reckless and argue that a bank that sloppy should foot the bill. The courts ended up siding with the bank instead of the little guy. So there you have it. 3 wild stories about how a few wrong keystrokes turned Wall Street dreams into nightmares. UBS in 2001 fumbling Dentsu's big debut by offering shares at 13 cents instead of thousands, costing them millions. And then there was Mizuho Securities in 2005, accidentally selling a whole company for peanuts, all because a trader flipped the price and the quantity. 27 billion yen gone, just like that. And Armin S versus BNP Paribas in 2015, where a typo almost caused a solo trader to hit the jackpot. These small mistakes weren't just oops moments, they were multi-million-dollar wake-up calls. And what ties them all together? Tiny human errors in a world that doesn't forgive, whether it be Wall Street, Tokyo, or Frankfurt. Precision is everything in that world. But people there are far from perfect. Just one small typo can manage to crash stocks and send markets into frenzies. Companies can bleed cash and their reputations can take serious hits. And yet, although none of us have likely swayed markets, there's something so relatable here. We've all at some point mistyped a text or misclicked a button. The difference between our mistakes and theirs is that ours don't cost us fortunes. So the next time you're rushing into something, just be grateful your keyboard isn't wired into millions of dollars. If you enjoyed this video, please consider following our Patreon linked in the description below. And as always, thank you for watching.